India will be more similar to China. The bar for going public on Nasdaq is so high.
Right.
It was still difficult for the Indian startups to arrive at that point. Everyone will always ask each other and say, "Oh, this manager has delivered such strong performance in the past, but now they are raising a $1 billion fund. Will they continue to deliver?" One problem was too much capital went into India in the good years.
Right.
And now that problem has gone away. In fact, too little capital was coming into India.
Right.
So a problem became an advantage.
Right. So Chris, thank you so much for being here and welcome to Mumbai.
Thank you for inviting me to this podcast. I'm very honored to participate in this.
Great. So this morning we were at the IPO listing ceremony of Capillary Technologies on the Indian public markets. How was your experience?
It's been more than 15 to 20 years since I've been working on such venture and private equity investment activities. Surprisingly, I've never attended any IPO ceremony. So thank you for inviting us to participate in the ceremony this morning. It was a very good experience.
It was our pleasure to have you there, and this will be the first of many IPOs, I hope, in India for you.
I'm sure. Things are looking like they are developing in a very positive manner.
Right.
I'm looking forward to more opportunities to participate.
Great. To kick off the conversation, Chris, can you take us through Axiom Asia? How would you introduce Axiom to the world?
Axiom is a private equity focused fund of fund investor. We only invest in all these private equity companies in Asia, and we do it by several ways. One, we are a primary fund investor, and by committing capital to all these private equity venture capital fund managers in Asia, we get to know some of these top performing companies in the private markets, and we can therefore participate in co-investments together with our GPs.
Right.
And thirdly, we also are a secondary investor. So whether it is buying portfolios of companies from GPs on a secondary basis or purchasing stakes directly into companies on a secondary basis, we also can provide capital to the industry that way. So there are multiple ways that we can engage with the industry.
Right, right. And Chris, what has been your personal journey like? How did you end up being the managing partner of Axiom Asia?
I think it's just one step follow another.
Right.
I was educated initially as an electronics engineer. I wanted to study overseas after graduating from high school in Singapore, and chance upon a scholarship provided by the Japanese government to study in Japan, and I chose to do that. So I had to travel to Japan in the 80s to first learn language for a year, and after that I was able to study electronics engineering in the Japanese university for the next 4 years. And then after I finished studying, there was an obligation on my part to go back to Singapore to serve for about 7 years as a civil servant in the Singapore Civil Service.
Right.
So for that 7 years, I was working as an electronics engineer with the Military of Defense and working as a tech guy.
Awesome.
Yeah. And life there was very interesting. I could be very focused on doing a very specific piece of engineering work for a long time.
Right.
Very intellectually very satisfying.
Right.
But at the same time, I also wanted to broaden my horizon beyond a very narrow engineering focus, and that was why I was studying for my MBA on a part-time basis. So by the end of 7 years, my bond obligation was over. I started interviewing. That was in 2000. It was the peak of the dot-com boom.
Right.
So every tech guy wanted to participate in the the venture capital ecosystem.
Right.
So I followed the same trend and I got a job with GIC, the sovereign wealth fund in Singapore,
Awesome.
because they were looking for a tech guy to do venture capital investments for them.
Right.
And that's how my journey into private equity started.
Right.
And I was working for GIC in their California office.
Oh, wow.
It was really a dream come true for me.
So that was the cutting edge of the tech revolution.
Tech revolution. Imagine I'm an electronics engineer, being able to land and work in Silicon Valley. That was really a dream come true.
Nice.
Yeah, so it was so great. I remember driving down the 101 freeway and looking on the left. Oh, that's Yahoo. On the right. Oh, that's Intel. Wow.
Nice. And this was 2000.
There was 2002.
Okay.
Yeah.
Okay.
Starting in 2002, I was in California.
Okay.
So
the boom had already become buzz.
it was a buzz, and it was actually a good introductory lesson to the volatility of the venture capital industry. Fortunately, GIC was a very long-term investor that participated in the venture capital industry right from the get-go.
Right.
In the early years, they were LPs in very renowned names today, in VC funds like Matrix Partners and Sequoia Capital.
Right.
So GIC had a long history of investing in venture capital. So I was part of this team that made venture funding commitments for GIC with some of these top Silicon Valley-based VC firms.
Right.
So very good experience. Learned a lot from those years in GIC. I'm very thankful for the experience.
Right.
And then in 2009, as we all know, the global financial crisis happened. And I was on the way back from the US back to Asia because we all thought that there wasn't much to do in US.
Oh, really?
I mean, in 2009, everybody thought the US was going to be in this doldrums for a decade.
Right.
Yeah. So people were leaving the Silicon Valley. So I was one of those leaving. And it happened that Axiom was raising its Fund 2.
Right.
And my boss was actually one of the co-founders of Axiom. So I spoke to him.
So your boss from GIC?
Yes, my boss from GIC co-founded Axiom.
Right.
And so I spoke to him and they said, they were raising Fund 2. They needed more people to do the work. And then I said, I'll join you. That's why I made a transition from GIC to Axiom. And that's been my last job so far.
Awesome. Yeah. And how has it been from a investor focus on US?
Mm-hmm.
Now you're focusing on Asia.
Mm-hmm.
Are there any reflections you have on how that transition has happened in terms of Asia being a very small part of the global venture and private equity ecosystem back in, let's say, 2009 and where it's today?
Oh, that is quite an amazing journey for Asia. Obviously, the whole venture capital concept originated in the Silicon Valley. They invented the idea. And it's quite an amazing idea to be able to nurture young startups with capital, giving all these brilliant engineers a chance to prove their business ideas.
Right.
And create big companies that completely overturn traditional industries. It's just an amazing business idea. And so I observed that firsthand in the Silicon Valley. And I was actually quite disappointed. Why doesn't Asia have the same thing?
Right.
Yeah. So when I came in 2009, that also coincided with the boom of venture capital industry in China. So as many of the audience here will know, a whole group of US venture capitalists came to China and set up their own China affiliates. And firms like renowned firms like Sequoia, Matrix all set up their China affiliates to invest in ventures-backed startups there. So there was this transfer of ideas from America to China.
Right.
And so those people, the venture capitalists, that learned all these capabilities very quickly from the US. And as we all know, China startups really produce strong growth once they were given support and capital.
Right.
And then we saw a similar trend starting to take off in the rest of Asia. Most predominantly in India.
Right.
So that was a very good timing in 2009. So Axiom started investing in China venture capital funds and also in India venture capital funds.
Right.
So it's quite heartening to see this new idea of venture capital going from America to the rest of Asia, and all these brilliant engineers having a chance to prove their business idea.
Right.
It's just an amazing development.
Yeah. And Chris, when you look at your participation across the Asian markets, how has it evolved? Like in the beginning, in let's say Axiom Funds 1 and 2, what was the portfolio mix like between countries?
Mm-hmm.
And what is it today?
We have always created a diversified portfolio, both in terms of country exposure and also sector exposure.
Right.
So Axiom had always been investing in all the major economies like China, South Korea, Japan, Australia, and India. And in terms of sectors, we have also invested into buyout, growth capital, and venture funds. So this mix of strategies and country existed in every venture fund, every Axiom fund. It's just that different strategies come in and out of favor because of the business cycle.
Right.
So sometimes certain Axiom funds will have more weightage towards China, and the other Axiom funds there will be less China and maybe more of the other countries or strategies.
Right. Right. And what about the mix between different strategies between primary, secondary, and co-investment? Has that mix evolved over time, or has it been a constant?
Oh yeah. How much we invest in each of these categories all depends on the opportunity set at that point in time. There's ebbs and flows. So there's no fixed rule of how much is allocated to which particular box in the whole matrix.
Right.
So it all depends on the bottom-up analysis of the opportunity set at that point in time.
Right. Yeah. Right. So Chris, let's switch gears. Would love to understand your perspective of what you're looking for in GPs. From an Axiom perspective, when you evaluate GPs, what are you looking for?
The question is like asking a blind man, what does an elephant look like? We all know the answer, right? Depends on which part of the elephant you're touching. The answer is different.
Right.
But some basic elements are quite common for all LPs. You're always looking for a team of very highly intelligent, highly motivated individuals coming together to form a firm.
Right.
And that's one thing. The second thing will be you would like to see this team having demonstrated some track record in what strategy that they are proposing to raise a fund for. And then finally, we also look at the competitive dynamics. The investment industry is an extremely competitive industry. Right. So every GP believes his own strategy has a good chance of doing well. But that's just from the GP's own assessment. Then our LP's job is to kind of compare and contrast. Does the GP strategy stand a good chance of outperforming all the other GPs who are also competing in the same market? These three sets of analysis that the LPs work on before they decide to make a commitment to a GP's fund.
Right.
Yeah.
And are there any key questions you need good answers to for you to understand whether a GP has an edge in that market?
It is it's a very qualitative judgment. So take the venture capital fund as an example. I found that every GP has its own unique way of doing business. And I've seen many of the best performing GPs, both in the US and in Asia. There's no fixed formula of how to organize a VC firm, how to make the team work together, whether it should be a firm with, there are many permutations, for example, whether it should be a firm with all partners and almost no analysts or associates. There are firms like that.
Right.
And then there are other firms which have a few partners and supported by a big team of analysts and associates.
Right.
So that's one example of different permutations. And different firms work in a different way. And it's difficult to say which strategy will work better just by looking at the strategy itself. It's always a case of looking at the strategy, whether it fits well for this team of people who are working together. So looking at strategy-wise, it's hard to decide which firm has an edge in the market. So we tend to look at something simpler. For example, you want a high-quality team of people who are able to work together cooperatively. Because just take the extreme example, you have one GP firm and then a firm with a couple of GPs. Yeah, that one GP may be a superstar, but he's just one person.
Right.
And trying to make venture capital investment is like trying to drink from the fire hose. Yeah, he has to digest so much information in the market, right, all by himself. And he has to look for the right entrepreneurs and all that. It's just unbelievable amount of work. So even if he's a superstar, it's tough for one person to do so much work.
Right.
Whereas three individuals coming together to form a firm, they may not individually be as stellar as this one man GP, but three guys working together. If they're working together cooperatively, probably they can cover a lot more ground and help out each other to find more entrepreneurs, evaluate more ideas, and also brainstorm better.
Right.
So that's why typically LPs like to work for firms where you have multiple GPs who can work together cooperative. Then the job of the LP becomes complicated. Three guys working together. How is their dynamics among themselves? And we have LPs have encountered so many partnerships that didn't last because people didn't agree to work together in certain ways. Because they are all human. They have different temperaments. I think there's a bulk of my due diligence, figuring out how they work cooperatively. And at the same time, usually in the firm, they also have other more junior people. Ideally, I would like to see these leaders in the firm being open-minded people. They can encourage the junior folks to surface ideas. They are not just executing the GP's ideas.
Right.
Then again, it's also the whole firm working together. There's a multiplier effect across the entire team.
And from a global LP perspective, right? Let's say there's an institutional investor from the US or Europe, and they're trying to now access the Asian market. What are some of the challenges that you have seen they face if they want to start deploying directly into the Asian market?
The LPs from the developed markets in America and in Europe, they come from developed markets where some strategies had done extremely well, namely buyout strategies. So many of them come to Asia and say that, they don't want to invest in the venture capital industry.
Right.
Because in their home market, they found that it's hard for them to invest in venture capital industries because the top names are difficult for them to access.
Right.
So in their home markets, they've just invested predominantly into buyout funds. So they fly into Asia, and then I hear them saying, I only want to look at buyout funds. I don't want to look at growth capital funds. I don't want to look at venture capital funds. First thing is in the home markets, they have never done much of that before. And then they also see that performance difference in venture funds is huge.
Right.
Whereas buyout funds are not that big. Right. So it's also a very scary industry in terms of risk. So I can understand where they're coming from. But Asia is a very different market compared to their home markets. So sometimes I feel that they have to let go of their home biases and take Asia as it is and kind of create a new strategy to invest in Asia rather than just bring the strategy from Europe and America and apply it to Asia without any adjustments.
Right.
Yeah.
Right.
Then in that case, they can harvest more of the returns from Asia.
Right. Right. And how have you seen the Asian ecosystem evolve from, let's say, early stage to mid stage to buyouts? Because private markets have been nascent ecosystems in Asia. Can you take us through each of the large countries and talk about where they are in their cycle of development of private markets?
that will be a very long answer. Let's take one emerging market and one developed market example. So emerging market says, let's take China, the largest economy in Asia. China's private equity industry really started first, I think, more with the venture capital industry. So people really took notice of China because some venture-backed companies like Alibaba and Baidu went public.
Right.
That was in early, when was that? Early 2000.
Right.
And then everybody woke up, oh, wow, there's this group of venture-backed companies that can grow to such large scale and profitability.
Right.
And they still were growing extremely fast after IPO.
Right.
So that woke everybody up, and all the foreign investors came into China and started investing into venture capital. And at the same time, some of these growth capital funds also started raising capital, and they produced very strong returns. So venture capital and growth capital both grew very quickly in China into a full-blown industry with many, many GPs over time. But there are still very few control investments in China. One thing is that there were not many promoters who are willing to sell control to their companies. And second thing is there's a lack of availability of debt in China. So due to these two elements, there are very few control transactions in China.
Right.
So not much buyout funds to invest in. And then the other example will be from a developed country like Japan. And Japan was very different. Japan's private equity industry was predominantly a buyout industry. It is because there are a lot of all this, first, on the large end, there are all these Japanese corporations that had access. They have divisions where they are non-core to the company going forward.
Right.
So they want to carve them out.
Right.
And so those carve-outs were sold to many of the large buyout funds. And on the small end, there are all these small privately owned businesses where the founders needed to get an exit because his next generation is not interested in becoming the successor.
Right.
And those naturally became targets to be sold to buyout funds.
Right.
So the buyout industry had always been very vibrant in Japan. And then more recently, I would say in the last 10 years, then the Japan venture capital industry started to take off. And some unicorns were created and went public in the Japanese stock exchange.
Right.
And that success, very much similar to what happened to China with Alibaba and Baidu, changed people's perception of venture capital in Japan.
Right.
Young, promising engineers realized that, oh, if he can do that, I can try too.
Right.
So that drew more talent into the industry. Right. And now we are seeing a nascent venture capital industry in Japan starting to grow.
Right.
Very probably you'll be on a parallel track to what happened to China in the past.
Right.
Yeah.
Right. And where is India from your perspective in that trajectory?
India will be more similar to China. India, you have always had some of this growth capital funds for the longest time.
Right.
India had a false start with venture capital during the dot-com boom.
Right.
We saw some false starts like that all over Asia, including Japan. A lot of dot-coms were created and then they all went bankrupt after the dot-com bust. So India had a few venture funds that were created during the dot-com boom, and then they all had difficulties raising successor fund. The exception was, we all know, Chris Capital.
Yes.
They changed from a venture fund into a growth capital, very successful growth capital fund today. So they managed to pivot and survive like a venture-backed startup.
Right.
So the problem with venture in India was LPs were quite enthusiastic, surprisingly. Including Axiom. We had been investing in India venture capital since our Fund 1, which was a vintage 2006 fund.
Right.
Yeah. And on hindsight, it was quite a very courageous move because all these LPs were investing when they couldn't see all these venture-backed startups going public in India.
Whereas in China, there were exits at that point in time?
In China, they could see companies like Alibaba and Baidu.
Right.
They were of such scale and
Right.
profitability that those companies could go public in the US.
Right.
So they could see the exit.
Right.
So when you're investing, you can see what's the end point. Whereas LPs investing in India venture in the early days, in 2006, they were investing with blind faith that eventually an Alibaba of India will emerge and go public in NASDAQ.
Right.
But they have not seen an example like that.
Right. Right.
Yeah, so it was that's why I say it was a very courageous move on the part of the overseas LPs.
Right.
To bet that India will also create a similar ecosystem like China.
Right.
And then on hindsight, we now know those vintage years, many of the VCs had difficulty producing exits.
Right.
Just because it's the bar for going public on NASDAQ is so high.
Right.
It was still difficult for the Indian startups to arrive at that point. So there were very few companies that made it. Make My Trip was one rare exception to the rule, but it was a rare exception.
Right.
And then, of course, on hindsight, we all know the game changed in 2021.
Right.
When all these venture-backed companies were able to go public domestically.
Right.
Yeah.
Right. And it looks like the exit ecosystem is so crucial, right, for you to invest in Asia. Can you take us through what's your perspective on the exit ecosystem as of today in 2025 across each of your major markets in Asia?
So the Chinese startups or growth capital backed companies, they have two major routes nowadays. Typically, it's either in the domestic stock exchange or to Hong Kong.
Right.
Yeah. Then Korean companies have been experiencing some difficulties in the last few years. The Korean stock market had not been doing very well.
Right.
From 21 onwards. And companies were still going public, but they were going public at very low valuations. So the VCs were not going to get a strong return from those IPOs. So VCs have been holding back on getting exits.
Right.
So, but now we are seeing light at the end of the tunnel because Japan, the Korean stock exchange index has gone up significantly over the last few quarters.
Right.
So maybe we'll see IPOs happening again in Korea. So if they couldn't go public, so the VCs were getting exits from M&As, selling their companies to strategic buyers. That's how they got their exits. Japan has a very vibrant domestic IPO market. So they have no problem listing their companies. So that's relatively easy. And then now we see the same thing in India.
Right.
So domestic IPO is now a viable exit channel.
Right.
So things are looking good.
Right. And what about the secondary market? How do you view the evolution of secondary markets in Asia?
Secondary market has become more of viable exit channel for investors. I think there were a lot of biases against secondary exit. I think it's just inherent bias against something new. It felt like a poor second choice compared to an IPO or M&A.
Right.
Yeah, but over time, I think when you've seen successful exits, GPs able to exit their portfolio and give some distributions to LPs. LPs are happy, and then and the people who bought into the secondary also made some good returns. So both parties are happy.
Right.
Then that gives people confidence that this secondary market is a viable option for investors.
Right.
To get liquidity from an illiquid asset class.
Right.
So I think it's a very good development in general.
So Chris, you've been investing in Asia over the last 15, 16 years at Axiom. Would be curious to understand, are there any views you held, let's say 15, 16 years ago, which you have had to change or challenge through the evolution of the markets?
Yes, definitely. So we spoke about the dot-com boom and bust in the US. When I joined Axiom, I saw the same boom and bust with, say, India venture capital. Right, during the financial crisis, many companies didn't make it.
Right.
At the same time, some of these India growth capital funds had raised a lot of capital suddenly, and then they found it difficult to get returns back to their investors. Many of the companies didn't deliver the kind of returns that the GPs were looking for.
Right.
So the whole industry went through a significant downturn, both growth capital and venture capital. And many firms had difficulty raising capital. So I think the conventional wisdom that foreign investors had was India private equity is a difficult market. Let's not touch it. Yeah, that was a conventional wisdom for a long time, post-financial crisis. And Axiom was no different. We also suffered some losses from our early investments into India venture capital and private equity. And so we were very cautious with investing in India. Everything in India was looked through with a comb through with fine comb. Took extra care. But we never gave up on the geography.
Right.
We felt that we could see that the potential is huge, and we know what was the problem. One problem was too much capital went into India in the good years.
Right.
And now that problem has gone away. In fact, too little capital was coming into India.
Right.
So a problem became an advantage.
Right.
The second thing was the issue with exit. Yeah, venture backed companies couldn't go public because the scale was not big enough for the US. So that problem remained. But we persevered. We thought that we still should pick some managers in India to continue our presence. So we made very small, what we call Toho commitments into some fund managers, both on the growth capital and venture capital side.
Right.
Because we thought that even without an IPO, some of these companies, that the best companies will still be acquired.
Right.
And we were seeing M&As happening. We think that that would be enough to generate enough returns for our fund investments.
Right.
That was how we continued being engaged in India.
Right.
And then obviously after 2021, the problem with exits went away.
Right.
So we think that the opportunity in India today is much better than 10 years ago. So our minds about India definitely went through a sea change.
Right. Right. And what about the GPs in India? What has been your experience about the GP quality and their thesis? How has it panned out over the last 15, 16 years?
GPs have also made the same kind of observations that we have about the industry. So many of them have drawn lessons from the difficult years and structured their funds appropriately. For example, they will raise funds that are of reasonable size versus the opportunity set they are targeting, so that they are no longer trying to push capital to companies when the companies don't need it.
Right.
And the other good thing that happened post 2021 was interest rates have gone up worldwide. Cost of capital is now higher, so capital is more precious and difficult to raise. And companies are no longer, as a result, companies are no longer growing at all costs, without regards to the bottom line.
Right.
So all those changes are good in terms of delivering long-term returns to investors.
Right.
Yeah. So I see a very positive development.
Right.
Yeah.
And if I can ask your advice for Indian GPs, what are some of the aspects that Indian GPs don't fully understand about the LP perspective that you would like them to understand better?
People who become GPs in the private equity industry, they are among the smartest people of the generation.
Right.
They understand what the investors want.
Right.
I believe every single one of them understand it. It's just that for some reason, some GPs choose not to deliver what the LPs want because there's a misalignment of interest. So we try to invest in GPs where there's a better alignment of interest between the GP's interest and the LP's interest. and then the GPs will deliver what the LPs want.
Right. I'm curious, with the rise of mega funds globally, do you think that we have reached a stage where the mega funds do have the institutional misalignment between LPs and GPs?
I think is many LPs know that it's difficult for a big fund to deliver the outlier returns. Because the underlying companies that they back, they only go public with a certain amount of market cap. Right? Then you divide the market cap by the ownership and the returns in terms of dollars going back to the fund. You can do the math. A big fund just find it harder, irrespective of the quality of the GP.
Right.
But some LPs invest because they in venture capital, and yet they are afraid that they will invest in a fund that underperforms. Some of these higher quality big funds, the chance that they underperform significantly is very low. So some LPs choose to go down this route. They want to invest in venture capital, and yet they don't want a big downward surprise.
Right.
So they choose to go this route.
Right.
Whereas other LPs choose to go with the higher risk, higher return strategy, invest in a few smaller managers, but construct a portfolio that has a high probability of producing a high return.
Right. And what about the argument that the outcomes are also increasing in size every decade? Is that an argument for larger fund size, or do you think that smaller funds will still produce a better return?
Yes, this argument that always floats around. But if you just look at the venture capital industry in the US, the most mature and leading industry in venture capital, some of these premier GPs are still raising smallish fund from $200 to $400 million.
Right.
And these are names that have been around for more than 2 decades.
Right.
So they are very smart people.
Right.
They know that the math works better for them if they raise a smallish fund and deliver consistently and maintain a high bar. And those funds are always oversubscribed. LPs are always clamoring to get in, and most people can't get in.
Right.
So if the leading venture capital market in the US is like that, why should Asia be any different?
Right.
The scale of companies developed in Asia are much smaller than in the US. So arguably, if it's 200 to 400 in the Silicon Valley, in Asia, the funds should be smaller.
Right. Got it. And going back to the due diligence question, are there any other points that you like to diligence when you're looking at GPs?
Whether we make a strong return or not from a fund investment is dependent on factors that we can predict and due diligence on, and factors that are just bets. So we try to do all the due diligence we can on factors that we can observe through due diligence, like due diligence on the team, the dynamics, how they work together, finding out about the strategies, things that we can observe and document on the investment memo. But there are other factors that due diligence alone will not uncover. And those are the unknowns that we are betting on. So one of the unknowns will be the external macro environment over the cycle, this 10, 15-year cycle of this venture fund. It could change to the upside. For example, the GP may be focused on just SaaS investment.
Right.
And if SaaS investment goes on an upcycle in the next 10 years, this GP will be a top decile performer.
Right.
And that is a factor that the GP cannot control. It's just an external environment factor.
Right.
And as an LP, if I choose to back this GP, I'm also betting that the GP is correct, that this sector will be on the upswing in the next 10 years. So did I make that bet correctly or not? So that's one thing that nobody can control. But you just consciously identify what bet you're making, and then decide that this is the driver of return, and you are consciously making a bet. Then there are factors like the exit market. Nobody could have predicted. Most people would not be able to predict that the IPO would see such a huge upswing in 2021 in India.
Right.
So there's another external factor that couldn't be predicted in advance.
Right.
But if it happens, then you benefit. Yeah. So we when we make a commitment to a VC fund, say in a certain country, we identify some of these unknown bets that we're making, unknown factors that we're betting on. And then we construct a portfolio of VC funds all across Asia to make sure that all these unknown factors, they are not fully correlated. Then we have a very robust portfolio. Whenever some of these factors swing to the upside, we will have outlier return. And then it will not happen in every single fund that we bet on. So hopefully for the other funds, if all these external factors don't go in their favor, but at least we are backing on very high quality people. They will give us a reasonable return, but not an outlier return. Yeah. Then on the whole portfolio will do okay.
Right. And Chris, are there any factors that matter a lot, but LPs don't really give much importance to? Have you come across any such factors?
I think there's a bias. LPs come in two groups generally. Some LPs, they will only invest in managers with proven track record. If you're not raising a fund 4, don't talk to me. Yeah. So
very familiar.
Yeah, I mean, that's just their strategy. They have this bias. They don't want to invest in what people call the emerging managers. So that's their own strategy. And our own experience had been very different. We invest in both of these managers with very established track record. We call them established managers. But we also, in our portfolio, have a group of emerging managers. We found that they are very complementary. Every LP would like to invest in a manager with a proven track record and have some confidence that they can sustain the performance going forward. Then we feel that we are taking very little risk and we will get good returns. Who doesn't want that? It's a rational thing to do. But some of these established managers, over time, things happen. Teams may not see eye to eye. Their strategy or sector may no longer be so relevant. So past track record doesn't sustain itself going forward. And then the industry that focus in may go through certain headwinds. Again, the future is different. So we have to be very alert whether to continue to support an established manager or unfortunately sometimes we may have to not re-up in the asset manager's next fund and then use that capital to back the next set of emerging managers. And we looked at our track record and we found that we had some very, very good outlier performance for some of our emerging managers. So we don't rule out either category of managers. We have them both.
Right. And are there any factors that LPs stress upon a lot, but you found that doesn't really correlate to performance?
This is one of the most commonly asked questions secretly among LPs. Of course, they don't ask the GP because it will be impolite. LPs will always ask each other and say, "Oh, this manager has delivered such strong performance in the past. But now they are raising a $1 billion fund. Will they continue to deliver?" They are always gossiping among ourselves. Then we all shake our head and we say, that's a very tough question. I don't know. But they are such an established brand. All the entrepreneurs say they look up to this VC firm and they would love this VC firm to back them. There will be great validation for the startup. So obviously, they have very good deal flow. But at 1 billion, can they still return 3x of the fund? Then we all scratch our head. So then LPs draw different conclusions. So that is a very difficult call to make. Whether it's a VC fund or buyout fund or growth capital, at different sizes, all the LPs eventually ask this question. How long before things break? So I feel that sometimes if you realize you cannot answer that question, why don't you choose not to answer that question and look for an answer somewhere else.
Right. So Chris, in your experience, what advice do Indian GPs need to hear from a global LP perspective?
LPs are, at the end of the day, we are all investing for financial returns. So GPs have to balance the two major metrics, right? The TVPI and the DPI. Ideally, the VC fund should have an increasing TVPI over time, and then the curve for DPI will continue to rise. It will be lagged, but it will continue to rise over time. So you got to keep these two metrics at the back of your mind all the time.
Right.
I mean, in the 10 years ago, when capital was free, we always saw this divergence. TVPI keep going up, but DPI continues to become flat, lay flat. And sometimes it's quite painful because there will be some GPs who have a company that was doing very well. They kept raising up rounds, and the GP had opportunity to sell down some of their stake in the secondary market, because 10 years ago, IPO was difficult, right? But they could always sell in the secondary market, the stake in the secondary market, and harvest some returns. But some GPs didn't take advantage of that opportunity because they believe so strongly in the underlying company and held on to the companies. So, and then as we know, venture-backed companies are operating in a very competitive market, and they are very fragile, small companies. There will be hiccups, and then that valuation of that company will plummet because some bad things happen, and the GP after that lost that opportunity to deliver returns to LPs.
Right.
And then they face difficulty raising the successor fund.
Right.
Yeah. So the LPs always tell GPs, if you have a chance to take some gains off the table, you don't have to exit the entire position. You take some gains out and give some distributions back to the LP, so that the LPs know that, this company is real. People are really valuing this company so highly. And then they also get some capital back. So that balance will be very helpful to build trust with the LP and make the raising of the successor fund a lot easier.
And it's okay if they leave money on the table in the initial partial sales?
The LPs will not blame you for leaving money on the table, but they will be they will be very angry if you didn't take advantage of the exit opportunity, and then subsequently they felt that they lost money,
right,
because the company's valuation came down because they ran into some hiccups.
Right.
Then they will really be very angry with the GP.
Right.
Yeah. So take a balanced path. You don't have to take all the money off the table, but take some. Right. It's a safer way to operate a long-term franchise.
Right.
Yeah.
Right.
Yeah.
And in this global competition for capital, what should an Indian GP bring to the table to win capital for their funds?
It's all about differentiation. GPs are very innovative. They always have some differentiated strategy that they pitch to the LPs. So that's one thing, to stand out from the crowd. The second thing will be a right size fund for your strategy. The third thing will be, give the LPs a good deal. Financially, economically. I don't have to elaborate on that. The GPs are always smart. They know how to give the LPs a good deal. Just cut them a good deal. And LPs will be summoning you to your fundraise.
So in your journey as an investor, has there been any particular investment or any event that was a turning point for your investment philosophy?
I think some decisions have helped our performance a lot. Going where other LPs are running away. It's a little bit like what Warren Buffett says, right? Be greedy when others are afraid.
Right.
Yeah. So there were a few funds where one fund, they had a breakup of the two key men from Fund 1. So the remaining key man was raising his Fund 2 alone with some new partners. And so many of the Fund 1 LPs did not re-up. So the Fund 2 fundraise was very, very difficult. We did our analysis of the deal attribution for Fund 1. We found that the better deals were attributed to the partner that was raising Fund 2. So we decided to back him in Fund 2. We were 50 million out of the $160 million fund, almost 1/3 of the fund. And then fortunately, that GP really delivered and produced a very good return for us in Fund 2.
Right.
So that was one example where we went against the grain. The second example this was a GP that had already raised 4 funds, very spectacular funds, 1, 2, and 3. And Fund 4 was a very big fund. And then they found that very difficult to deploy the big fund. They deployed it into 2 large deals that didn't do well. So when they came back to raise Fund 5, many of the LPs couldn't go back to the IC to do a re-up decision. Although I think most of them would conclude that this GP was a very stellar team or GP. But because they were disappointed in the last fund, they couldn't re-up. Again, we went back and we looked at the track record of GP. We felt that they just made some mistakes by investing in those large transactions, which was out of their sweet spot. Right. So we supported them in raising the next fund, and we gave them, again, like 50 million out of a $200 million fund. We were 1/4 of the commitment.
Oh, wow.
And they didn't disappoint us. They delivered on deals in their sweet spot.
Right.
Again, produce a spectacular return.
Right.
So, ignoring what other LPs are doing, if we think that what they're doing is not right in the situation, in these 2 cases, we felt that the general LP community was not right. General LP community is generally very smart. So be very careful if you're going against the crowd. But in these 2 cases, we felt that the crowd was not really correct. Right. So we went against them, and then on hindsight, we proved to be correct in those 2 instances. So we follow that preaching. Be greedy when others are fearful.
Right.
But better make sure you're right.
That's very important. As you look to 2026, what are some of the key trends that you're watching from a geopolitical perspective in Asia?
The biggest change in recent memory, obviously, is the changes that happened to China. Right? It went into an economic downturn post 2021.
Right.
And also, the government was very hostile towards all these privately owned businesses.
Right.
So it became very difficult to make investments in China. But now the government has turned around. It has realized that it needs the privately owned companies to supercharge the economy again.
Right.
So now they are becoming very friendly to the private companies.
Right.
So we are assessing this change in the government's attitude and policies and seeing what is the right time to start investing again more in China. That's one big variable to watch. The other markets will be, the other variable will be India and Japan. Both stock markets have performed spectacularly in the last few years.
Right.
And GPs have harvested their investments through IPOs. That's been a very positive development. So then a lot of capital has flooded into the Japanese buyout industry.
Right.
Then what Warren Buffett will be telling you is when other people are greedy, you may have to be afraid. So now we are watching that. Is it time to be afraid, or is it time to slow down? That's another variable they're watching.
Right.
Yeah. And then with India, this IPO window has been open for so long. And then the obvious question is, will it slow down? When will it slow down? So those are the questions we are asking ourselves.
Right. But Asia is a huge place with it's just so diverse, so deep.
Mhm.
So can you give me maybe a few examples of how your local expertise has helped you navigate this market versus just a global LP who's flying in, flying out and building a small portfolio? Can you bring out the value proposition that you offer?
Uh, I think it's just a lot of legwork. Meeting as many of the GPs as possible.
Right.
Both the established GPs and also the emerging managers. Getting a very good sense of what is the best risk return that we can get from the market. And then within each market, our focus is really very much on finding country-focused managers. We find that in that with that strategy, we can pick the best team suited for each strategy and each country. And then as we can create a portfolio and get diversification. So I don't know how some of these other foreign LPs can replicate the amount of homework that needs to be done. It's just a lot of analysis and then collecting performance numbers for all the various funds. You just have to talk to each GP. There's no shortcut. You just have to talk to them and ask them how's their performance, and then you construct this database of GP's performance. Then you can assess whether they are doing well or not. Yeah.
Right.
So we just have to do the homework.
Right.
Yeah.
Much easier to just partner with you guys, right? For
that's one solution.
Great. So, Chris, we cannot have a conversation without the topic of AI. So, I would love to get your perspective, having started your investment career during the .com boom and bust. What's your take on what's happening with AI?
I should ask you. You are the expert. I'm just taking in first-hand information and reproducing it here. If AI is as disruptive as people say, it is. Some people say that it is even more disruptive than the advent of the internet. Then we will see the impact of AI across industries over the next decade or so. At this point in time, we can already see a lot of doubts appearing in the media that there could be overinvestment in AI in the US.
Right.
And then some people are also saying, all these LLMs in the US, despite them spending so much money, they are only incrementally better than much cheaper models produced by the Chinese.
Right.
So what's the point? Right. So it's natural for doubts to appear. And people have learned their lesson from the .com boom and bust that they shouldn't get too excited when a new wave of technology hits the market. If the wave of technology is so disruptive, you have time. You should wait for the first wave of euphoria to die down. Then you go in and invest at a cheaper valuation. So we are now watching this wave to see whether we should have more exposure to AI. For example, we could pick a AI-focused VC fund to invest into. But is this the right time? We're asking that question. We already have exposure to AI through our generalist manager. Right. Each of them will have one or two companies that is an AI company. So I think we can observe the industry carefully and then make our decision.
Right. What is underappreciated today, which is going to seem very obvious, let's say 5 to 10 years from now?
It will be, say, continuing with the example of India, it will be the returns from all these India-based growth or VC funds.
Right.
The returns will be good. And then it will become obvious.
Right.
And as per normal in the LP community, everybody will be coming to India and flood it with capital, and then the game will reset itself after a few years.
So in your investment career, Chris, what has been some of the most memorable meetings you have had?
This happened many years ago when I was speaking to a Indian startup. The founders were talking to me about how they created this idea for their startup. So I always I was very, very amazed. How did these founders come up with all these smart ideas to create a new business model that would completely change the industry? So how can they be so far-sighted? And when I talked to these founders, then I realized the answer. They told me, before we started this startup, we identified 5 problem areas. And then we brainstorm and try to come up with solutions for all 5 problems. And then we assess our solution for each of the problem and evaluated which solution solved the problem in the best way. Then they picked the best of the 5 to go with their startup.
Right.
Then I thought, that's how they do it. It's not magic. They actually have a very systematic way of figuring out how to solve a problem and then trying to figure out whether the solution was complete or not.
Right.
And then it was only much later that I learned that this methodology was quite prevalent in the whole startup ecosystem. People do trial and errors to figure out solutions to problems.
Right.
Yeah, so that was quite insightful to me.
Right.
Yeah.
What's in your list of anti-portfolio? Are there any big misses that you have had in your career?
Every investor will have big misses that they regret. There were funds that we passed on that produced spectacular returns. And then we would do a review to see what was wrong with our assessment and try to learn from those lessons. For example, there was one fund where the GP said that he would continue to do his angel investment on the side. And when the company is mature enough for a Series A, his VC fund will get the opportunity to invest in the Series A round. So we passed on that fund because we felt that it was a clear conflict of interest. But we asked the GP, how can you do this? This is a clear conflict of interest. But the GP said, but it's a privilege for you to be able to invest in a Series A round of my seed portfolio. So we walked away from that opportunity. And on hindsight, it was the wrong financial decision. That fund performed spectacularly.
Right.
But it is just not the right investment for us.
Right.
Yeah.
Right. So, Chris, in this diverse and complex ecosystem, which is Asia, how do you keep up with what's happening? Are there any routines, habits? How do you keep up?
I remember speaking to Ashish Dhawan, founder of Chris Capital. He told me that when he wakes up in the morning over breakfast, he'll read through 5 newspapers at one go to get a grasp of what's happening to the economy on that day.
Right.
So I kind of followed what he taught me. Yeah. So we try to ingest as much information as possible. So like most people, I'll be reading the news, reading tech blogs, listening to podcasts. I think we discussed about the Acquired podcast. I think is very, very educational.
Right.
Trying to get updated on the latest developments across the world in the industry.
Right.
So keeping up to the latest news is quite important for our job.
Right. And do you, when you read these 5-6 newspapers or news channels, are they from different countries? And like, do you need to have diverse inputs as well? Let's say from the Chinese perspective or the Japanese perspective or the Indian or US perspectives, because there could be some differences or nuances.
Yes, we read news from each of the countries.
Right.
In fact, in each of the languages.
Right.
So we have a team of people who can digest this news from different media. Because sometimes the Western media may not catch up to the latest news coming out from China. Because it will be the Chinese media that will be the first to get the news out.
Right.
So fortunately, we have constructed a team of people who are fluent in the various Asian languages.
Right.
So we try to keep up to date as far as possible.
Right.
It's a team effort.
Right. Right.
Yeah.
So last question as we wrap up. So on your visits to India, are there any memories that you have created in India?
Well, India is an amazing country that has come a long way over the past 10, 15 years. I always remember my first visit to the Taj Mahal. It's quite a mind-blowing experience to see such a building
Right.
existing. It seems to be out of nowhere. Yeah. So yeah, I admire all the history that India has. And I'm very happy to continue to be able to engage in this economy,
Right.
to see India through its next leg of development. I'm very excited about that.
Awesome. And thank you for your time, Chris. It was a pleasure speaking with you. And we hope to see you more often in India.
Thank you. Looking forward to it.